down close candle. Just like this, up close, larger down close. Up close, larger down close. Up close, so I'm expecting larger down close, the takeout sell side here and trade into this inefficient area. Okay. So with that being said, I have my prediction for Wednesday. Now we have to go find an intraday trading model to get in line with that. This is where this is the hard part. This is where everyone gets it wrong. This is where you lose your money. You might be able to determine that higher time frame direction, but the tricky part is finding your entry and not getting stopped out and nervous and scared out of the trade and change your mind. So we're expecting what, guys? Again, we're expecting a large down close day. So here's our open. We trade up, power of three, then we trade lower, okay? Let's redo that. Sorry. That was sloppy. So we're expecting lower prices, guys, all right? We have a buy side run, liquidity run here. We trade up, we take out buy stops, then we reject lower right away. We rally back up, we rebalance it, and then we trade lower right away. Okay. It's very important. Your eyes need to start seeing that. This is the 1 minute chart. As soon as we do this right here, we trade lower aggressively and we displace lower on the 1 minute chart. You want to note that high, look left. Where did that high form at? And why did a high form here? Well, we look left, we have a fair value gap. Okay. And we displaced lower. When you get that displacement, you always want to note your high that we displaced from. And you always want to look left because 9 out of 10 times there's going to be a valid reason why we displaced from that level. In this case, it's this fair value gap and we displaced. So now what do we expect to happen, guys? We expect the next 1 minute candle to open, power of three, trade higher, and rebalance that displacement and then continue lower. Where's your stop loss going to go? Your stop loss is going to be at your swing high that we just displaced from. Look left for value gap. So if we're going to trade lower, there's no reason to break this level. And every single time you enter a trade, there's risk involved, okay? Nothing is 100% certain. You have to understand that, guys. There's no 100% trading strategy. There's always going to be risk. So when you do put risk on inside of the market, you might as well frame it to where it makes sense. We had buy stops ran here. We're expecting a down close day into that daily fair value gap that I already outlined at the beginning of the video. We had here's 930. Here's your 930 manipulation move right here at 930. What happens? I'll draw a vertical line at 930. 930. Just like yesterday's video, I told you guys that 930, there's going to be some form of manipulation. So when you pull up your charts at, let's say, 10 a.m., let's say you didn't get to the computer until 10 o'clock in the morning, all right? You missed the 930 bell. Well, here's 10 o'clock, all this consolidation, all right? You always want to look left and note what has previously happened. What happened around 9:30 a.m.? Well, here's 9:30 a.m. here, and we got a huge blast off higher. Boop. Take out equal highs, buy stops. That was your 9:30 opening bell manipulation. And then we trade lower. Trade back up, rebalance, trade lower. Now we're consolidating. No one knows what's going to happen now because price is just going back and forth real tight. Then we trade up a little higher. Where do we trade to? Look left, fair value gap. And then we displace from that. Right there. That's your entry. Right here. Okay. Your stop loss realistically needs to be here, but if you want to get real cool with it, you can put it at the candle high that displaced. Here's your displacement candle. You can put it at the high of that, but you might get stopped out with spread. Who knows? There's your displacement. Here's your fair value gap. Another one. We're expecting lower prices, remember? So here's your fair value gap. There's your displacement candle. We open the next couple candles. We dig up into there. We rebalance that level. And then what happens, guys? We trade lower. If we're expecting lower prices, this is the same thing. If we're expecting price to move lower from here, this level, we create an up close candle here. We're expecting lower prices. So what happens? We have a larger engulfing candle right after this up close candle. Engulf. There's your order block. So the next candle, open, power of 3, trade higher, boop, and then trade lower. You can do your little inversion stuff here. Here's a buy side imbalance. Here's a sell side imbalance, the one that we displaced from. There's your inversion fair value gap. Isn't that what that doggy kid's all about? Doggy. $100 says he'd come on here. If you saw this, he would comment and say, "That's not a real inversion fair value gap." That's what they all say. Like, for example, if you're trying to trade turtle soup and Romeo's egotistical scumbag ass, he's going to say, "That's not a real turtle soup. Only mine are real turtle soups." That's the ego talking, guys. Similar to ICT. Like if you master order blocks and then you trade this order block, what's he going to say? "That's not a real order block. That's not a real one. Nope, only I know the real ones." Like doggy, only I know the real inversion fair value gaps. That's not real. Romeo, only I know the real turtle soups. That's not real. Like it's the ego talking. Okay. Sometimes you can be wrong. Yeah, it can not. Yeah, it can not be a real one. But I mean, fuck, people are trying to learn. Who cares? So this looks like a real inversion fair value gap to me. But it also made sense because we're expecting lower prices. Here's that fair value gap. So you have a 1 minute market maker sell model. Original consolidation, distribution, redistribution, smart money reversal. Where's the smart money reversal happen at? Happens at a PD array. Where's the PD array? Right here. And then displacement lower. Now we're on the right side of the curve, guys. So you can draw your vertical line. As soon as we start to trade on the right side of that curve of the overall market maker sell model, you can put that vertical line here. So you have the left side of the curve here, right side of the curve here. Your PD arrays and imbalances on the left side should match up pretty well with the ones on the right side. And here's a perfect example of that. Buy side imbalance on the left side, sell side imbalance on the right side. You trade down, trade up. They use it as resistance. They rebalance and then they trade lower. Where are they going to trade to? They're going to attack original consolidation. So you got your market maker sell model. So you always want, even if you come into the market around 10 a.m., you always want to look left and note what has recently happened inside of the session, specifically right around 9:30. In this case, 9:30 opened, traded higher, took out buy stops, went short. consolidation, manipulation, distribution, redistribution, smart money reversal. And that's when the right side of the curve comes down. And we're expecting this to really sell off. Why? Because our overall target is this higher time frame fair value gap, buy side imbalance. We can go ahead and note the midpoint of that, which would be right here. We haven't traded down there yet, guys. So this is a 1 minute model. Beautiful stuff. If you actually pay attention, this is beautiful. Look how far down we traded. You could have took 50% of your trade off here at the swing low or just under it, and then let the rest ride, and you would have tripled